Welcome to a special deep dive. Today, we are taking a really granular look at the Albertsons Companies Inc. That's ticker ACI, Q3 2025 earnings conference call.
Yeah, this one was held pre-market on January 7, 2026, and it gives us just an absolutely crucial read on the U.S. consumer.
And not just the consumer, but the whole grocery sector, right? It's just such an incredibly competitive world.
Razor-thin margins. And, ACI management has been trying so hard to reshape their story for investors. They want to move away from that grocery grind narrative.
To what?
To being seen as a scaled, data-driven retailer. That's the key phrase they keep pushing.
So the core question we have to answer today is, did these Q3 results actually help that mission? Or did all the headwinds facing grocers right now just steal the show?
Well, the market gave us a pretty clear answer by the end of the day.
It did. And the reaction was decidedly cautious.
That's putting it mildly. I mean, look, ACI delivered solid operational results in Q3, but the stock was down almost 6% by the closing bell.
Which tells you investors were looking right past the current quarter.
Exactly. To prioritize the signals on future margin pressure and some of these external regulatory things over the immediate earnings beat.
Okay, let's unpack that stock reaction then by looking at the headline numbers. It was a classic mixed bag.
It really was, which often just confuses the market.
So starting with the good news. Adjusted earnings per share, or EPS, came in at 72 cents.
Right, and that was a comfortable 4-cent beat over the consensus of 68 cents. So check mark there.
But the problem was the top line, revenue, which for them is net sales and other revenue combined.
That came in at $19.124 billion.
Which was a slight miss. The street was looking for $19.17 billion.
It's not a huge miss, but a miss is a miss. Now, on the surface, identical sales, which, is that key metric for growth in existing stores, did grow a pretty resilient 2.4%.
And a 2.4% identical sales number in this environment with all the promotions. I mean, that's strong execution, no question.
It is. But the market looks at the quality of those sales, and that's where the story soured pretty much instantly. The profitability metrics just diverged sharply.
Okay, so this is the divergence that drove that negative sentiment.
Absolutely. The operating metrics showed this really clear mix shift toward higher costs. Gross margin dropped to 27.4%.
That's a 50 basis point drop year over year. That's not small.
It's not. And because of that, adjusted EBITDA was just $1.039 billion, down from $1.065 billion the year before.
So wait, you have an EPS beat, you have 2.4% sales growth, and the stock is down almost 6% by the close.
It sounds like panic, but it signals this profound distrust, mostly focused on the future. Investors are asking, if things are solid now, why are margins getting worse?
And the answer to that comes down to internal choices and external headwinds.
Exactly. Let's start with the internal drivers in that gross margin breakdown. Management specifically detailed a 55 basis point decline if you exclude fuel and LIFO.
Right. And just for context, when they exclude LIFO, that's last in, first out inventory accounting. They do it because it can be really volatile with food inflation.
So stripping it out gives you a cleaner look at the underlying operations.
Got it. So setting those accounting things aside, what were the two big factors driving that 55 basis point drop?
Okay, the first is structural. Higher delivery and handling costs. And that's tied directly to their digital growth.
We see that everywhere. The last mile is expensive.
It's the great unsolved puzzle in grocery. And the second factor was just a sales mix shift toward pharmacy, which, just has a lower margin profile.
So is ACI basically sacrificing profit now for digital market share later?
It's a bit of both. They are growing digital sales fast, which is critical, but they haven't achieved that profitable scale yet to really minimize those handling costs.
But to their credit, they did show some discipline elsewhere.
They did. Their selling and administrative expense rate was actually down 33 basis points year over year. So their productivity work is helping, but it's just offsetting these other rising costs.
Okay, that covers the internal challenges. Now we have to talk about the massive external pressures that really spooked the market. SNAP and the Inflation Reduction Act.
Right. So the first one, which was more minor but immediate, was the delayed SNAP funding in November. That was because of the whole government shutdown threat.
And how much did that hurt them?
Management estimated it hit their Q3 identical sales by about 10 to 20 basis points. So not huge, but not trivial either.
And the second one, the Inflation Reduction Act, or IRA. That's the long-term beast hanging over them, isn't it?
It is. The Medicare drug price negotiation part took effect January 1st, 2026, and the impact on their top line. It sounds really brutal.
So brutal.
Management said Q4 identical sales will see an estimated 65 to 70 basis point headwind just from this one change.
Wow.
And for the full fiscal year 2025, that's a 16 to 18 basis point drag on identical sales.
Okay, explain this to me because this is the nuance investors are debating. How can a massive revenue headwind like that not hit the bottom line?
Right, it sounds like an accounting trick, but it's not. Management was very clear. This is a top-line pressure only. The IRA means the reported sales price of certain Medicare drugs has to be lower.
Okay, so when they sell the drug, they report less revenue.
Exactly. But the cost of getting that drug and dispensing it stays stable relative to those negotiation terms. So the dollar amount of profit is pretty much untouched.
So it's net neutral to their adjusted EBITDA and their P&L.
Correct. But if you just look at the trimmed revenue guidance without understanding this, you will massively misread the health of the company.
That clarity is absolutely vital. So given all these headwinds delivery costs, IRA, how is management planning to overcome them? This is where that whole tech pivot comes in.
Indeed. Their whole strategy hinges on technology. Digital sales grew 21% this quarter.
And the loyalty program?
That swelled by 12%. They're at nearly 49.8 million members now. They have the customer data, they have the platform.
And the CEO really leaned into the AI lever, saying it's not just a buzzword for them. They're partnering with Google, OpenAI, Databricks.
And what's really compelling is they're citing actual proof points. The most powerful one was about their customer experience.
What was that?
Customers who use the new Ask AI search tool in their app are showing an approximate 10% increase in basket size.
A 10% lift. That's a measurable return on investment. That's rare to see this quickly.
It is, but that's the tension, right? If AI is so great, why were delivery costs still a headwind this quarter? It suggests the efficiency gains aren't scaling fast enough to beat the labor and fuel costs.
And to fund this whole thing, they have that massive productivity goal.
A staggering $1.5 billion in productivity gains over the next 3 fiscal years.
That is not a small number.
No, and that money is earmarked to fund price competition and innovation so they can keep up with Walmart and the hard discounters.
And they were active on the balance sheet too, right? Post-Kroger deal falling through.
Very active. They continue their $750 million accelerated share repurchase program, the ASR.
Which is just a fast way to buy back a lot of stock.
Right. And on top of that, they did a big $1.5 billion refinancing, basically pushing out their debt maturities and reducing near-term risk. It's just sound financial housekeeping.
So all of this is happening against the backdrop of a really tough consumer environment. What did management say about shoppers heading into 2026?
They confirmed it's intensely promotional. Lower-income shoppers are stressed, as you'd expect, but the pressure has generalized now.
Right, the trade-down behavior. That was a standout from the call.
It was startling. They pointed out that even higher-income, traditionally stable shoppers are showing more price sensitivity.
Buying ground beef instead of steak.
Exactly. Or trading down from brands to private label. It means the promotional pressure isn't going away, and that puts even more stress on gross margins.
And all that, the consumer pressure, the IRA drag it, force them to trim their guidance.
Yep. Full year 2025 identical sales guidance was narrowed to a range of 2.2 to 2.5%. That's down from a high end of 2.75%.
And EPS.
Also narrowed to between $2.08 and $2.16.
And that guidance trim is exactly why the stock dropped 5.9%.
It's a show me story now. The market needs proof that this digital and AI strategy can deliver profitable scale. Until then, they're just another low-margin grocer.
They did mention one potential bright spot, though, in the pharmacy business. Something about GLP-1 therapies.
Yes, the weight loss drugs. They see the potential growth from the new pill formats as a possible future tailwind. But they were cautious. They're modeling it as net neutral to EBITDA for now, which is the smart move.
All right, time for our segment. This is not financial advice. We're moving into the hedge fund pod analyst mindset, offering a high conviction, maybe a little outrageous, but plausible trade idea.
Okay, so the central conflict here, as we've discussed, is a narrative split. The market is punishing ACI for being a traditional grocery stock, caught in margin hell.
So it's trading like a boring consumer staple.
Right, but management is trying to run it like a high-growth tech company.
So what's the trade to play that perception gap?
We propose a pair trade.
Yeah.
You go long ACI, short XLP, which is the consumer staples ETF.
Interesting. Okay, walk us through the logic. Why short the whole staples sector with XLP?
Shorting XLP hedges out all those industry headwinds we just talked about, the promotional intensity, the consumer trade down. You basically neutralize the risk of just being in a tough sector.
So you're isolating the company-specific story.
Exactly.
So then why go long ACI specifically, given the margin pressure we just spent 10 minutes talking about?
Because you're longing ACI to capitalize on that deep discount relative to their transformation story. If management delivers on even a fraction of that $1.5 billion productivity plan,
and if that 10% basket size lift from AI actually scales to, say, 20% of their nearly 50 million members,
then ACI should fundamentally outperform the rest of the low-growth staples sector. This is a bet that the AI-driven advantage will eventually win out, especially once that temporary IRA headwind cycles out of the comparisons in 2026.
a very compelling, aggressive thesis, betting that technology can actually transform a low-margin business.
It's a big bet.
So, to wrap up this deep dive, the Q3 call was a real paradox. A solid operational quarter, completely overshadowed by regulatory changes and intense investor concern over margins and guidance.
Yeah, ACI is executing its strategy. They are aggressively pushing for productivity. But the market isn't buying the story yet. They want evidence. They want proof that digital can scale profitably.
Management openly said on the call they think their valuation doesn't reflect the long-term earnings power they're building. So the provocative thought to leave you with is this. Given that ambition, how many quarters of disciplined AI execution will it take for the market to finally start believing the data-driven retailer narrative over the stubborn reality of the grocery grind? That's the tension you need to be thinking about.